Hi, dividend growth stock investors. A very happy Saturday to you. Colby, the DGI crab, coming at you with dividend increases. Typically, I've done these every Saturday in the history of the channel. I've actually decided that on a go-forward basis, I'm going to do a month review of dividend increases for the stocks that the channel covers. I think that'll just be a bit more of an efficient way to handle these. Still going to bring you all the good news of the increases, but I'd like to have some time to focus on a couple of other types of video content. And I just think that we can kind of knock these out and review them more efficiently on a look back at the month. So already did a couple of these. We looked last month at Fastenal, and gosh, I'm already forgetting what the other one was. It was a disappointment one too. That's why I'm forgetting. Anyway, beside the point, go back and check that one out from just a couple of weeks back. These are the remaining dividend increases for the month of January. We've got 5 of them right here: S&P Global, Air Products and Chemicals, Cincinnati Financial, BlackRock, and One Oak. If you're new, this channel covers 60 high-quality dividend growth stocks. Those are split into 4 separate categories, or tiers as I call them, based on the age and time horizon of the investor. And as it just so happens, I've got a representative here from each of the 4 tiers here. So we can kind of go through these, see if they lived up to expectations, what it is that we want to accomplish out of owning those particular stocks. So we're going to start out with S&P Global here. S&P Global increased their quarterly dividend. They're going to go from 91 cents per quarter up to 96 cents per quarter, which represents a 5.49, we'll call it 5.5% increase. Now, S&P Global is in the Tier 1 category of stocks, meaning these are growth-oriented stocks designed for the 18 to 30-year-old investor with a lot of time on their horizon to build up a nice passive stream of income. S&P Global was a major disappointment in 2024, only increasing their dividend by 1.11%. when what we're wanting to get cumulatively out of these stocks each year over year is well above 10%. So SPGI really brought this group down overall. The biggest disappointment of the entire group for 2024. And while a 5.5% dividend increase isn't necessarily a terrible thing just in general, for a stock that typically is going to yield less than 1%, I definitely need to see a higher dividend growth rate than that. If we look at the dividend scorecard on SPGI, payout ratio is sitting at 24%, meaning they've got loads of room to continue increasing that dividend by more than 5%. So this one was kind of unfortunate. 5-year dividend growth rate has slumped down to 9.8%. They are dividend king with 51 years of dividend increase streak going. But you can just see here, the last couple of years, they've slowed that down a bit. They had a long string of doing double-digit dividend increases. Even 2022 and 2023, I can't beat them up too much over. High single-digit increases. It's all right if a business wants to go a little conservative for a year or two to conserve capital, but then in 2024, we had that awful 1% increase. And in 2025, if this is the only increase that we are going to see, then it's going to be another disappointing year for SPGI. And you can see here, they typically do that increase in the first quarter. So I'm really not expecting them to do an additional increase. Maybe they will, but it would be out of character for them to do so. All right, now that one was a disappointment. I think this is going to be the biggest disappointment of the group for me. Air Products and Chemicals. This is in the Tier 2 category for the age 31 to 41-year-old investor. 2 to 3% yield with a high single-digit growth rate is a nice thing to shoot for here in this particular age range. And Air Products and Chemicals, listen, you guys, the share price over the last year plus has been great. This stock is way up. About this time last year, it was around $230, $240 a share, going through a bit of a slump, all the way up to a $335 right now. It is not an undervalued stock in my estimation whatsoever. But Air Products and Chemicals, again, this was one that had a very disappointing dividend increase in 2024 as well, of just 1.14%. And this year they've announced a dividend increase going from $1.77 to $1.79 per quarter, which is just like last year. We're talking about a 1.13% dividend increase. Definitely not what we are looking for from APD. And then Seeking Alpha's actually got this dividend growth incorrect because of the way that it came on the schedule. Let's see here, and you'll see here what I mean. Because you see they do quarterly payments, and then for whatever reason this year that fourth quarter payment just didn't quite hit the end of the year, fell in January. That's got Seeking Alpha all messed up here. But, if you can see here, if you go back and look at the quarterly payments, I mean, this is one that usually does really nice dividend increases, double-digit increases at that. 134 to 150, 150 to 162, 162 to 175. And then just this very meh at best 2024 dividend increase, just going up 2 cents a quarter. It looks like they followed that up with the same one again this year. Very, very disappointing from a dividend payout perspective. If we look at the dividend scorecard, their payout ratio is at 56.8%, which is still quite safe. Certainly not like SPGI's down there in the 20s, but I don't think that APD necessarily seems to have anything to worry about in terms of not having a lot of room to raise that dividend. So I'm pretty bummed out by this particular dividend increase as well. Again, share price has done great, but certainly not anything that's super exciting. And then also in that tier 2 category, we have BlackRock. Now, BlackRock, similarly, share price doing incredible. BlackRock is way up on share price. It looks overvalued right now in my estimation. But BlackRock jumped their quarterly payment up from $5.10 to $5.21, which represents just a 2.16% increase. And BlackRock was one of the disappointing dividend increasers in this category in 2024 as well. We're kind of seeing a theme here. BlackRock just did a 2% increase in 2024, and this one is just a little bit better than a 2% increase again this year. Their growth rate indicates that they should be doing high single-digit or better dividend increases. Payout ratio is at 46%. That's probably something that I do need to update on my spreadsheet. I do need to check that from time to time. I'll go ahead and do that live right now. 46%, excellent payout ratio, nice and safe. Shouldn't have any problem paying out dividends, but they have just slowed that dividend growth down to a snail's pace. If we look at the history, this is looking like it's going to be the third year in a row that they've done this dividend increase in the twos. But going back further, you can see much larger dividend increases paired with a lot of the times higher dividend yield too, but that share price is just way up right now. So the yield is low, the dividend growth is low. I absolutely love BlackRock as a stock. It's been a great performer, but certainly not adding to this one when it looks overpriced because the dividend increases just are not there. Now, on to the better news here. If we go into our Tier 3 group of stocks, which is where Cincinnati Financial finds itself, Cincinnati Financial did an 8% increase last year, which is just great with me. It's pretty in line with what they typically do. With the Tier 3, age 42 to 53-year-old investors, we're looking for like 3 to 4% starting yield, mid to high single-digit growth rate as a group. Cincinnati Financial, not necessarily a household name unless you happen to be a dividend investor, and then you definitely are going to know who Cincinnati Financial is. 64 consecutive years of increasing that dividend. Longtime dividend king. Payout ratio at 47%. 5-year growth rate on that dividend of 7.66%. They have increased that dividend from 81 cents per quarter up to 87 cents per quarter, which is good for a 7.4% increase, right in line with what we are typically expecting out of Cincinnati Financial. If we take a look at the dividend growth history here, we can see a lot of high single digits. A couple of years here where I'm sure this was, again, just scheduling problems here in terms of getting a dividend payment announced or added. at a particular time. It just throws off these seeking alpha algorithms, because you can see here it's 30%, then negative 16, 30%, negative 15. This is just, again, this is just when the actual payment fell. But the quarterly payments are really what we're actually looking at here, and that's what's making it that dividend king. You can see here 81 cents all of last year, 75 before that, then 69, 63, 60, 56. So you could just see so incredibly steady. Every once in a while, it looks like they may even throw a special dividend out there like they did in 2027. We never count on special dividends, but if you get them, great. Cincinnati Financial, very solid, very stable, long track record of increasing the dividends. That's why it made that tier 3 category for me, and they have basically done exactly what they needed to do again. And then finally, if we go over here to tier 4 with One Oak Incorporated, One Oak, I think they really hit the ball out of the park with this one. So they went from paying 99 cents per quarter to $1.03 per quarter, which represents a 4.04% dividend increase. They are, based on their history, the most overvalued stock in this group of 10 stocks for the 54 and older investors that are looking for high starting yield and slow but stable dividend growth. They did a 3.66% increase last year, so getting a slightly better than 4% increase this year is really nice for this particular group of investors. They are, they're not necessarily needing the massive raises, but they do need the nice high starting yield. And One Oak really has done a nice job here. The share price has just shot up, and the dividend payouts have been very consistently going up. Now you'll see they did have a few years in like 2020, 2021, 2022. This is an energy company, mind you, so some of that may have had to do with COVID. Some of it may have had to do with the acquisition of MMP, I believe is what it was, an MLP. They have an 82% payout ratio, which is fine with me. With these types of companies, the payout ratios can get a little bit higher. If this creeps up into the 90s, I may start to sweat it just a little bit. But as we look back on that history, even though the growth wasn't fantastic, it was very stable. We didn't see dividend cuts there. Very large market cap on this particular stock. And it's really nice to see a 4% increase on a higher yielding stock in that tier 4 category. One Oak, for me, if they could just do very small, very modest increases of like 1 or 2% in general, I'll probably be pretty happy with them. Especially because if I'm going to buy One Oak, they're going to be yielding 6.5%. Because I'm not buying anything unless it's very, very undervalued at the time. And One Oak yielding 4.2%. If you ask me, absolutely not undervalued whatsoever. If you look at the dividend yield history here real quick, we can see, just going back to 2015, the average yield on One Oak, it could vary a little bit. Some years are better than others, but usually we're trying to get that average yield, or we're trying to buy it at least in the 6% range, if not more than that. Ever since the COVID crisis recovery, they have certainly been doing a very nice job. The average yield year over year continues to go down. Man, in 2020, you could have been buying this thing at an average yield of 11%. Man, getting this one at an 11% yield, even though it would have been kind of scary at the time because of all of the COVID-related energy concerns, all of that business. If you'd have just known that this was a nice, stable company that was not going to cut the dividend, and they were going to find a way to continue to gradually grow it once the recovery was in full effect. I mean, my gosh, at the bottom it was yielding well above 20%. It's hard to time things that particularly well, but man, most of 2020 you could have gotten a double-digit dividend yield on this, and now you'd be getting raises in that 3-4% range on top of that. Hard to complain there. So, all right, you guys, these are the 5 stocks that increased their dividends in January that I hadn't covered with you already. This is going to be, again, something I'm going to do on a monthly basis, looking back. So I'm going to keep track of the February increases, and I'll report those back to you in early March. But even though there were a couple of ones that were disappointing that were in here right now, this is why you focus on a group of 15, 20 stocks. So if one or two of them disappoint, the ones that overshoot are going to make up the difference, and you'll have a stable portfolio that'll continue to increase over time. Till next time, this is Colby, the DGI Crab.